Hi, I'm Alexandra Ferrari with Ferrari Lending. Today we're going to take an honest look at the pros and cons of DSCR loan, what they do well, where they fall short, and most importantly, how to decide if they're the right tool for your investment strategy. Now you'll often hear DSCR loans described as the easiest way to qualify for investment property financing. And while that's true, there's more to the story. So let's go beyond the headlines and look at the full picture, from flexibility and scalability to cost, limitations, and long-term implications. Let's start with the positive side, the advantages that make DSCR loans such a powerful tool for investors. There are 5 main benefits that consistently make these loans stand out from traditional mortgage options. The first and biggest benefit is no personal income verification. With DSCR loans, you don't need tax returns, pay stubs, or employment verification. The approval is based on the property's ability to generate enough rental income to cover the mortgage. This is a game changer for self-employed investors, foreign nationals, or anyone who's structured their income for tax efficiency. By qualifying based on property performance instead of personal income, you unlock access to financing that most banks won't even consider. And that's the reason so many professional investors use DSCR loans to scale. The second benefit is speed and simplicity. Because there's no income documentation and fewer underwriting layers, DSCR loans can often close in 2 to 3 weeks, compared to the typical 45-day conventional timeline. This faster closing window gives investors an edge in competitive markets. When you can close quickly, sellers take you seriously. It also reduces friction and stress. You spend less time proving your financials and more time focusing on your next acquisition. The third major advantage is ownership flexibility. Most DSCR loans allow you to close directly in an LLC or business entity. That's not something conventional lenders typically permit. This means you can structure ownership for liability protection, estate planning, or tax efficiency, and keep your investment activity separate from your personal finances. For serious investors, this isn't just convenience, it's smart asset management. Next, let's talk about scalability. Traditional lenders often limit how many financed properties you can have, typically 10. DSCR lenders don't. There's no property count limit for most programs. That means you can continue building your portfolio as long as each new property meets the DSCR qualification. It's the foundation for long-term portfolio growth, where your assets pay for new assets and your leverage multiplies intelligently over time. Finally, DSCR loans are versatile. They can be used for single-family homes, condos, townhomes, multifamily up to 4 units, and even short-term rentals. If the property produces income, chances are it can qualify under DSCR guidelines. That level of flexibility is extremely valuable in markets where investors are diversifying between long-term and vacation rental strategies. Now, with all those benefits, it's important to understand the other side, the trade-offs that come with this kind of flexibility. The first drawback is higher interest rates. Because DSCR loans don't require income documentation, they're considered higher risk for lenders. Rates typically run 1 to 2% higher than conventional investment loans. That's not ideal for short-term holding periods, but for investors focused on long-term appreciation and cash flow, it's usually a fair trade-off. The key is looking beyond the rate and evaluating the total return on investment, not just the cost of the money. The second con is the larger down payment. Most DSCR lenders require 20 to 25% down. In some cases, it can be slightly more depending on credit score or DSCR ratio. That's because the lender wants to see you have strong equity in the deal. It's part of the balance between flexibility and risk management. For investors, this means you need to plan your capital allocation strategically, but the trade-off is stronger approval confidence and fewer underwriting headaches. The third potential downside is the prepayment penalty. Most DSCR loans are structured for long-term holds, so lenders include a 3 to 5 year penalty period. If you plan to flip or refinance quickly, this could affect your short-term plans. But for buy-and-hold investors, it's rarely an issue, and in some cases, you can buy down or customize the prepayment term. And finally, DSCR loans qualify based on the property's income potential, not your personal income. If the appraiser determines that market rent isn't strong enough, the DSCR ratio could fall below lender guidelines, which may affect approval or loan amount. That's why working with a broker who understands rental market analysis is crucial before you make an offer. So, are DSCR loans perfect? No, but they are one of the most powerful tools available for real estate investors who understand how to use them correctly. They offer flexibility, privacy, and growth potential. And in exchange, you accept slightly higher costs and strategic discipline. That's what smart leverage looks like. If you'd like to find out whether a DSCR loan is right for your next investment property, I'd be happy to review your scenario personally. We'll go through your goals, your property type, and your financing strategy to see how this program fits into your portfolio. Visit ferrarilending.com or contact me directly. I'm Alexandra Ferrari with Ferrari Lending, helping investors build smarter, not harder.